Really a pleasure to be here. I always like coming to Louisville, and I always like the opportunity to talk to chamber events because I think chambers play a very important role in defending and communicating the primary roles of business in our society. I also see a number of BB&T clients and shareholders, and I thank you for that very much. We really greatly appreciate your business. I do admit I wish I had a little more fun to talk about than the U.S. financial crisis, but it is a very important topic, and it doesn't seem to want to go away, and for reasons that I think I will be able to explain to you as I go through this presentation. Some basic backgrounds, 4 basic points. Government policy is the primary cause of the financial crisis we've been experiencing in the United States. We do not live in a free market. We live in a mixed economy. That mixture varies a lot by industry. Technology is probably 20% free, 20% government, 80% free. Financial services is more like 70% government, 30% free. It's not surprising that the most regulated part of the U.S. economy is where we've had the biggest problems. Secondly, government policy created a bubble in the residential real estate market. That bubble deflated, as all bubbles do, and that deflation was captured in the capital markets and then transmitted into the economy in general. Thirdly, a number of individual financial institutions made very bad decisions, and I wish those people had been allowed to go out of business. However, those decisions were secondary to the context of government policy. And finally, unfortunately, almost everything the government has done since this crisis started, even things that may help us in the short term, will be very detrimental to our long-term well-being. How did we get here? We invested $800 billion too much in residential real estate. We built too many houses. We built too big of houses. We built houses in the wrong place. And we should have been investing in manufacturing and technology, in education, and particularly we should have saved more and spent less. How did we make a mistake of that magnitude? Only government policy can cause such an enormous error. It takes a lot of resources to make that happen. And there are 4 primary sources of the problems: the Federal Reserve, the FDIC, government housing policy, and specifically Freddie Mac and Fannie Mae, the 2 large government-sponsored enterprises, and the SEC. In addition, government policymakers took a natural correction and made it a lot worse than it had to be. And finally, since this crisis started, we've been doing a lot of things that sound good that have long negative consequences for us. Fundamental cause of the financial crisis were decisions made by the Federal Reserve. This is interesting that probably most of us learn this as we go through school, but we don't really get what it means. In 1913, the monetary system in the United States was nationalized. The Federal Reserve took over the monetary system. We do not have a private monetary system. If you have problems in the monetary system, by definition, those are government problems. If interstate highway bridges were falling down, we'd all say, well, the government owns the highways, they're falling down. The government owns the monetary system. The Federal Reserve was created, in theory, to reduce volatility in the economy. Well, what has happened, they reduce volatility in the short term, but they create more volatility in the long term. In a free market, because we're not omniscient, markets are always correcting. Businesses are failing and new businesses are being created all the time. When you take out the downside of that correction process, all you do is push the problems into the future. The Federal Reserve itself will admit it was one of the primary causes of the Great Depression. In addition, the existence of the Federal Reserve creates a huge amount of extra leverage in our economic system. You know, a state can borrow you a lot of money because it has taxing authority, but it hits the limit. That's happened to California. However, the federal government can borrow almost infinitely because not only can it tax, it can print money. And as it becomes more leveraged, it has a huge motivation to keep printing money to spur inflation because it owes a lot of money. In addition, when the Fed tries to take out the downside, people don't save because a lot of savings happens in concern with risk in the future. The so-called Greenspan put reduced our savings rate, which has come back to haunt us. In addition, too, we had some very specific mistakes made by Alan Greenspan and then by Bernanke. Greenspan held real interest rates negative for over 2 years. What that means is you could borrow money at 2% and invest at 3%, when inflation was running at 3%, you could borrow money at 2%, which is a huge incentive to borrow. Created a lot of expansion in the monetary supply. And then Bernanke inverted interest rates, and what that means is short-term rates were higher than long-term rates. Banks borrow short and lend long. That created negative spreads in the banking industry, negative margins, which encouraged banks to take risky loans because they couldn't make any money except by taking risky investments. And almost all the bad loans were made late in the cycle at the end of the bubble. In a certain sense, the fundamental reason we had this large misallocation of capital and resources in our economy is because the Federal Reserve printed too much money. The Federal Reserve has a lot of smart people, and they use very advanced mathematical models, but the great free market economist Friedrich Hayek talked about something called fatal conceit, and that's the belief of smart people that they can do the impossible. I don't care how smart you are, you can't integrate the economic activity of 7 billion people. Second cause was FDIC insurance, which sounds like a good thing, but it destroys market discipline. And we saw that at BB&T in spades in Atlanta, where a number of community banks have failed. We took over one of those failed banks. It was an interesting kind of experience. 10 guys that were in the motel business got together. They raised a little capital. Then they got a lot of money by buying certificates of deposits at high interest rates. The typical depositor didn't care because they had FDIC insurance. They lent that money to their cronies in the motel business that all then went broke, and the FDIC lost about 50 cents on the dollar. On a bigger scale, IndyMac, Washington Mutual, Countrywide, 3 very large financial institutions, all which failed, were able to raise lots of money through deposits, through insured deposits, and they made high-risk loans with those deposits. You could not have had the high-risk lending activity that accompanied the boom that led to the crash without FDIC insurance. The proximate cause of the current problems we face is housing policy that has been a long-standing goal of our government. And the goal has been to raise home ownership above the natural market rate. Home ownership is certainly a good thing. However, there's no evidence that owning a home by itself changes human behavior. In addition, when you encourage people to buy houses they can't afford, you can have some long-term negative consequences. Tax policies supported housing. In particular, however, was the Community Reinvestment Act, which supported low-income housing, and then a very significant event occurred in September of 1999. I remember this well. That's where Bill Clinton announced a goal for Freddie Mac and Fannie Mae, these 2 giant government-sponsored enterprises, to have at least half their loan portfolio in affordable housing, now subprime lending. It was interesting at the time, a number of economists said, wow, this is risky. The legitimate affordable housing market is not that big. And if Freddie Mac and Fannie Mae achieve